Listen, your bank is probably robbing you right now. No, not with hidden fees, but with absolute silence. Welcome to today's Explainer. We're going to break down a pretty fascinating reality about our current economy, and I promise you, by the end of this, you are going to look at your cash completely differently. Just take a look at this number. Right now, the national average savings account interest rate is sitting at a measly 0.38% APY. To really put that into perspective, if you've got $10,000 just sitting in a standard traditional savings account at one of the big banks, you're earning a grand total of about $38 a year. $38? I mean, that barely covers a few cups of coffee, let alone keeping up with inflation. But then, check this out. The top high-yield savings accounts are currently paying out between 4 and 5% APY. These are accounts that are absolutely just as safe, just as liquid, and honestly take maybe 10 minutes to open online. It's a completely wild contrast, and yet millions of people are just leaving that money on the table. Okay, let's dive into this with Section 1, the silent bank robbery. And that brings us to Section 2, understanding the Fed rate. So what actually is the Federal Reserve rate, and why should you even care? Well, the Federal Reserve is America's central bank, and they control this thing called the federal funds rate. Basically, it's just the interest rate that banks charge each other to borrow money overnight. Now, I know, that sounds super boring and technical, but trust me, this rate is literally the central engine of our entire economy. It matters to you because that one single number trickles all the way down through the whole financial system. It dictates how much interest your savings account pays out, how much your credit card company charges you every single month, what your mortgage rates look like, how expensive a car loan's going to be, and it even influences whether businesses are currently hiring new people or laying them off. So as of April 29th, 2026, which was their third rate announcement of the year, the Fed actually voted to hold that benchmark funds rate right in a range between 3.5% and 3.75%. That means they've held interest rates steady 3 times in a row in 2026. And look, most people see a headline that says Fed holds rates, and they just scroll right past it. But that headline is currently either working directly for you or it's working against you. The Fed hit pause. They're in this wait-and-see posture, trying to balance inflation risks against a softer labor market. The simple translation, rates aren't going up right now, but they sure aren't coming down either. They're completely frozen.
Which leads us to Section 3, the winners, smart savers.
Now, what's really interesting about this is that if you're a saver, a frozen high-rate environment is actually a fantastic place to be, but only if your money's in the right account. The absolute best high-yield savings accounts out there are still reflecting that federal stability. Just look at these top rates from late May 2026. VioBank's savings account is earning 4.03% APY with pretty minimal requirements. Viro Money is offering up to 5%, and Oxos Bank is right there offering up to 4.21%. When you stack that up against the national average of 0.38%, it means the vast majority of Americans are earning practically nothing, while these high-yield accounts are paying out up to 10 times more. Let me break this down into pure dollars and cents for you. Let's say you've got $20,000 saved up. If it's just sitting in a traditional account at 0.38%, you're taking home a whopping $76 a year. But move it over to a 4% high-yield account, suddenly you're making $800. Move it to a top-tier 5% account, and you're pulling in $1,000 a year. You are literally leaving nearly $1,000 on the table every single year just because your cash is in the wrong bank. And the best part? These accounts are FDIC insured up to $250,000. So they aren't risky and they aren't complicated. They are perfectly designed for exactly 3 types of cash: your emergency fund, any money you know you'll need in the next 1 to 3 years, and any cash you're just holding on to while you figure out where to invest it. Oh, and as a quick bonus, if you think rates might actually drop later in 2026, locking in a certificate of deposit or a CD at over 4% today could protect that high rate for the next 12 to 24 months. That kind of rate locking is a brilliantly smart move when the Fed is holding steady. Let's shift gears a bit. Section 4, the losers, squeezed borrowers. Because every equation has 2 sides, right? While savers are absolutely loving this high-rate freeze, we've got to talk about the really painful reality on the other side of the fence. Because the Fed kept its benchmark rate elevated in that 3.5% to 3.75% range, variable rate debt is staying incredibly expensive, and borrowers are feeling the squeeze big time. Just look at this comparison. The average credit card APR right now is hovering around 20 to 21%. If you're carrying a balance month to month, you are literally bleeding money every single day. And auto loans, they're sitting at a massive 7 to 8% APR. On a $35,000 car, that is adding thousands of dollars in pure interest over 5 years. And since rates are frozen, there is no relief coming anytime soon. So the crucial point is this. A frozen Fed rate means high borrowing costs are sticking around. Your absolute number one priority, if you have high interest debt, has to be paying it off aggressively. Look at it this way. Eliminating a 20% credit card debt is literally a guaranteed 20% plus return on your money. Honestly, that's better than almost any traditional investment you could possibly make in the stock market right now. All right, let's get practical. Section 5, the one simple move. Knowing all this, knowing exactly how much you could be making and how much debt is hurting you, we arrive at the highly actionable part of this explainer. Here is your quick action list to stop the bleeding and maximize your returns this week, and I promise it takes maybe 10 minutes. Step 1, check your current savings rate at your bank. Step 2, compare it to the top high-yield savings accounts online. Step 3, open an account. Reputable options like Vio Bank, Marcus by Goldman Sachs, or Ally are all fantastic choices. Step 4, move your emergency fund over there immediately because right now that money is being incredibly lazy. And Step 5, attack your high-interest debt with every single extra dollar you can find. But you really have to listen to me on this one. The urgency is so real. High-yield rates are variable by design. The next Fed decision is already on the calendar for June 17, 2026, and the window to lock this in is closing fast. As we saw with the rate cuts back in 2025, the very second the Fed signals a cut, banks will start trimming their high-yield rates within a matter of weeks. You simply cannot wait on this. Let's move to Section 6 and see how this builds when rates finally drop. Even though rates are frozen today, nothing lasts forever. We have to prepare for the future economic shift and what exactly happens when those rates finally thaw out. When they do drop, it sets off a very specific chain reaction. High-yield savings account rates will fall quickly, which is why you need to capture them right now while they're high. Mortgage rates could ease up, which is potentially awesome news if you're house hunting. Bond prices will actually go up, which benefits those invested in bond funds. And those CDs we talked about locking in today, they are going to become incredibly valuable. If you lock in 4% for 2 years today, you are going to look like an absolute financial genius when the surrounding rates drop. Seriously, if you're a disciplined saver, you need to treat today's high-rate environment as a rare gift. As we wrap up today's explainer, I really want to leave you with this incredibly powerful quote from our source material. The Fed's decision affects every dollar you own, whether you're paying attention or not. The only difference between someone losing money to inflation and someone making thousands of extra dollars a year is just having this information. And hey, congratulations, you just became the person who knows. So, I'm going to leave you with a question to chew on. Are you already using a high-yield savings account, or are you finally going to make the switch this week? Take control of your cash, stop letting the banks rob you with silence, and make sure you join us for our next explainer where we're going to break down what's actually happening with student loans in 2026. You definitely won't want to miss it.